made your money when you bought it for dirt cheap and it smelled like dogs and cats, right? We want those ugly duckling buildings that we can convert into golden geese. So the concept is the same. And by taking those practice swings on smaller properties, it gave me the ability to recognize value in that commercial space, and then strategic partnerships with people that knew what I didn't know. What I had was
Hi, welcome to Investing for Generational Wealth. My name is John Clive from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income and cash flow, and tax benefits. Together with investors, we're investing in over 1,000 multifamily apartments under renovations, over 500 single-family homes under development, more than 350,000 square foot of industrial commercial real estate, over 700,000 of private loans, and we're expanding to other asset classes like oil and gas and others to help our customers, our investors, you, create diversified, balanced portfolios. Before we begin, a quick disclaimer, as always, we're not financial advisors. All investments are subject to risk. So please do your due diligence and consult your CPA, your attorney, before making any investments. Again, I'm your host, John Lai, and welcome to today's episode, Making the Switch to Truly Passive Investments with Clint Harris. I'm excited for our conversation and for Clint's personal journey from essentially an active investor to passive investing. He began his career in medical sales, and then he quickly pivoted to multifamily real estate professional. He launched Going Coastal Property Management to better serve short-term rental owners because he had a number of Airbnb units. And then he pivoted again to self-storage, joining Nomad Capital as a general partner. So obviously a ton of experience. So what sounds like a ton of active experience. So I'd be very interested to know his pivot to passive investing. And so let's get right to it. For those who don't know your history and your long career, Clint, could you give a brief description of how you got to where you are today?
Sure, John. Thank you for having me. I'm excited to be here. We've got a lot to talk about, so let's go over a lot of the things that I did wrong. Maybe that'll help. My name is Clint Harris. I live in Wilmington, North Carolina, married with 2 little boys. I spent a 16-year career implanting pacemakers and defibrillators. I worked as a medical sales rep in cardiology. That line of work is very high demand. It's heart problems are not typically Monday through Friday, 9 to 5, right? So it's a lot of long hours, especially in surgery or being on call, being called 2 to 3 hours away to different emergency rooms for different procedures. And that line of work is kind of a young man's game. It'll kind of burn you up over time. And I saw the writing on the wall there. So 16-year career before I left. And for 14 of those years, I was investing in real estate. Started off with my first house was a duplex. I lived in one half, rented the other half, that half out. And so I lived there for free. I thought I invented this concept and I was a genius. Turns out I was just a 23-year-old kid and didn't know any better. But from there, I bought 9 single-family homes in the post-2008 crash. Single-family homes are a very slow way to get ahead. I was doing BRRRR strategy, sometimes accidentally on a few of those. I flipped a few properties here and there. Things didn't really change for me until 2017. My wife and I took a promotion to Wilmington, North Carolina, took over the medical sales territory there. And that's at the beach. And that opened up the opportunity for being in an area that was good for short-term rentals. I came from South Carolina in an area that wasn't really known for that at the time. So we moved to Wilmington, North Carolina, and I remembered that first lesson from that first house hack, and we bought a duplex 2 blocks off the ocean, 3-bed, 2-bath in one half, 3-bed, 2-bath in the other. So we renovated, moved into one half, rented the other out, and did just under $60,000 the first summer. And I was like, oh, this is real money. This is a lot. It's a little bit more work, but it's a lot more money than a long-term tenant. So because of that, we had success there. We bought a quadplex and converted those 4 units to short-term rentals. Then we bought another quadplex and then another quadplex and converted those. And then at that point in time, I couldn't find a property manager that could manage the properties the way that we were, or get the numbers that we were getting by having a very data-driven, analytical, streamlined approach with automation in place. And so that turned into building a property management company. It took about 2 years to do that before I was able to hire myself out of that company. And that was great, but the big thing that I did wrong, it's honestly something that I did wrong with single families as well, is that I was just focused on the cash flow and I was looking for that financial independence, right? We all want that
Right.
financial independence so that I don't have to have a boss. But the reality is, you know, when I had those 14 Airbnb units as the first ones that I had, it was like, yeah, at one point I replaced my income as a medical sales rep. I was still doing both. But even when I wasn't on call with the hospital, I still had all these properties I was managing. Or when I built the management company, I had to manage the managers, right? And that was when I realized that that's really, financial independence alone is a little bit of a shallow goal. That's really not what we all should be shooting for. What we really want is that time, financial, and location independence. Those three things together create an independence of purpose where you go where you want, when you want, and do what you want with your life. And short-term rentals was not the way to get there for me. So
Yeah.
that started my aggressive pursuit of all things passive investing and passive investment strategies. I started a podcast, Truly Passive Income. And really, it was in around 2019, I met the guys that ended up being my partners just through local real estate networking groups. And then in 2020, we bought an old Kmart building. They had years of self-storage experience. Together, I put money in, they put money in. Some of the surgeons and cardiologists that I worked with put money in. We bought an old Kmart building for 1.5 million. We put 2.5 million into it and converted it into a drive-through climate-controlled self-storage facility.
Mm.
And the stabilized valuation on that was a little over 9 million. So that same light bulb moment, I was like, oh, this is real. And so then we did another Kmart and then another conversion and another and another and another. And I left my career in medical sales in November of 2022 and have been a general partner with Nomad Capital, full-time real estate investor, raising capital from investors, most of which are the old white coat professionals I used to work with. Now, obviously, it's grown from there. We're currently at 150 million in assets under management, looking to get to 500 million over the next 5 years and $1 billion in 10.
Wow. That's fantastic and very, very impressive. How did you go and pivot from your 14 Airbnbs, short-term rentals, to know that, commercial real estate or even the self-storage asset class is one of the classes that you wanted to get into?
So it's actually the same lessons that applied to the short-term rentals are the same thing that applied to our self-storage conversions, is that first of all, I understood the value of unit density, meaning if you have more rental units than you have sets of fixed overhead, then that's a benefit, right? I had done the math on Airbnb, and if I had 4 different condos with 4 different mortgages, 4 sets of taxes, utilities, and HOA fees, I would break even. But if I had one quadplex building with 1 set of taxes and utilities and mortgage and taxes, it would net 80 grand. So I was like, oh, I understand the concept of multifamily and how that creates value. And I also understood the concept of asset class conversion, right? I was buying a property with 4 bad long-term tenants that were month to month that hadn't had a rent increase in a decade. And over time, I'm in a nice way moving those tenants out. I'm renovating and converting and staging those properties, converting them to a different asset class that would 3.5 to 4x the gross potential rental income. That forces up the net operating income, maximizes the value on the property, and creates opportunity for refinance. I still own those 14 units. I'm in the process of liquidating some of them because the equity has shot up and I want to reposition into more self-storage. But the concept behind that, buying a small multifamily and converting it to a different asset class, is something that stuck with me. And so then when I met my partners and we were talking about self-storage conversion, it jumped off the page at me because it was lessons I had already learned before. I was like, okay, like, John, let's be honest. What we're doing is not rocket science. We take one big box, we chop it up into about 500 or 600 little boxes, and we rent them out to people. We take a building that's been sitting empty for years, and the town is just ready for somebody to do something with it. We buy the building for 2 to 3 million. We will put 2 to 3 million into it. And as a stabilized climate self-storage facility, they're typically appraising in the 12 to $17 million range. It's the same thing I was doing with Airbnb. It's just a few more zeros and obviously more heavy lifting. And that's why I'm blessed to have partners that are the GCs that can build that out. We do it in-house, but it's the same fundamentals that you use when you're flipping a house or anything else. Just like when you flip a house, you don't make your money when you sell it. You don't make your money when you renovated it. You made your money when you bought it for dirt cheap and it smelled like dogs and cats, right?
Right.
We want those ugly duckling buildings that we can convert into golden geese. So the concept is the same. And by taking those practice swings on smaller properties, it gave me the ability to recognize value in that commercial space, and then strategic partnerships with people that knew what I didn't know. What I had was a network and a group of friends and peers that are all very high earning individuals. They all eventually want to break free from the hospital system and the golden handcuffs, but they can't. They have money, but they don't have time. Without time, you can't get experience. If you want to have success in any kind of real estate investing, you have to have those three things: time, experience, and money. And if you don't have those, you need to find a strategic partnership with somebody else that has the pieces that you're lacking. And that's what happened with my partnership. And all I really had was the ability to recognize value, luckily being a good judge in character and having a network of people that were high net worth individuals that were all looking for a place to invest to break the cycle of trading time for money.
Right. I like that. We have a number of people in our audience that are in your position. They currently are in your position that you were in several years ago. Own residential, realize that the increase in their properties might not be worth the headache, the overhead. They want to do the transition as well, whether they want to be part of the GP or maybe be an LP. How do you recommend that they go about that transition?
Well, everybody's journey is going to be a little bit different. I think the best thing to do is sit down and take a self inventory. And sometimes that's hard to do. So sometimes I think it would be good to get some outside perspective, talk to people that you know, like, and trust, and get their opinion of what they think you would be good at or what you have access to. That's your circle of genius, the things that are going to make you valuable to other people,
Right.
and look for ways to take that and leverage it. Right. And you're right. Single family homes, small multifamily, it's a very, very slow way to get ahead. But if you're an active investor, you can go make better returns than you're going to get in what I can offer you. We're offering right now, it's a 19 to 22% IRR on the $10 million fund that we just wrapped up. So the reality is, if you go and you do something yourself, you're going to be able to beat those margins, but you're going to be trading time for money to do it. You're going to be that investor and you're going to do that. If you don't have the ability to go operate actively in the commercial space and do those properties, the best thing to do is either invest passively with someone else that's strategically doing that. And if you don't have the cash to do that, then the best thing to do is look at what you do have. Do you have the ability to raise money together? Can you get a pool of people together like you guys are doing and educate them on opportunities that are available? And in that situation, make it so that the whole is greater than the sum of its parts. A lot of times, if you have 10, $100,000 investors, they can all get a great return. But if you pool that together and you have $1 million, obviously you have the ability to negotiate preferred terms and get a little bit better there. So if you're the quarterback that's bringing that together and identifying the operators, then there's opportunity there. There is unlimited opportunity in the commercial real estate space. And I would take it one step further. And I would say that right now, so I got my first cell phone when I'm 42 years old, got my first cell phone when I was a junior in high school. It was the Nokia Brick. And then Facebook came out when I was in college. And then I remember my first BlackBerry Curve. And then I remember my first iPhone. And so I'm that generation that has seen the ability to connect and network in a meaningful way during my lifetime. And we just saw the last group of kids graduate college that didn't know what it was like to have Chat GPT and AI and the ability to network in a meaningful way there. I would say that the ability right now to educate yourself and connect with partners in a meaningful way is greater than it ever has been. And if we right now do not build a wealthy family, if that's what you care about, then it's a us problem, right? There's more opportunity than there ever has been. Now, there's also more noise than there ever has been. There's more
Right.
distraction and there's so much. So I think the reality is identify what you are good at or what you have access to and lean into your skill sets and just keeping in mind that you need those three things to have success. It's time, it's experience, and money. And most of us either live in a deal state or a money state. Like where you live, the state in which you live, if you're West Coast, it's very likely that you live in a money state where there's a lot of capital out there, but it's very hard to find deals that pencil.
Right.
I live on a little island called Carolina Beach right off of Wilmington, North Carolina. And the Southeast, the Sun Belt around us, we operate in North and South Carolina, Tennessee, Virginia, Georgia, and we're looking at some outlying areas. Those are deal states, right? And so a lot of our investors are either high earning white coat professionals that work around here or a lot of money coming from the Northeast or from the West. And you've got money states investing into deal states and you got deal states soliciting capital from money states. So what skills do you have? Where do you live? Can you put something of value together and partner with a strategic partner, understanding that you have to have that trifecta of time, experience, and money?
Yeah, I like that answer. That's the approach that we took at Clive Capital. And, some people go through masterminds and certainly you can learn that way as well. Some people say it's money well spent, but definitely if you can partner up with someone that has the experience and then you can either bring the capital and you can potentially have a good partnership. So it sounds like you guys have made a fantastic partnership. Kudos to you. Self-storage. Let's talk a little bit about self-storage as an asset category. Self-storage has, just like any other asset class, has gone through its ups and downs. Multifamily, when I think about that, it's past, call it 2-3 years. It's been on its down cycle. It's recovering at some point. But self-storage, can you talk a little bit about that? And is there a cycle? What do you think about the potential financial, I wouldn't even say recession just yet. We're not in a recession, pending financial issues that we might have, plus the interest rates either rising, potentially falling a little bit, but maintaining its state. How does that impact self-storage?
Well, first of all, let's start from the basis that I don't need to sell self-storage to anybody. And I don't care if you invest in self-storage or if you invest with us. I'll tell you if you're going to invest with self-storage, what you should look for. And I don't care if it's with us or with anybody else. Do whatever fits your journey is the best choice for you and your family.
Right.
It's the top performing commercial asset of the last 30 years. Self-storage at one point meant renting space in someone's barn to store your old truck or a low slung metal building along the side of a highway. That is not what self-storage is anymore. In fact, we've seen some significant consumer trends over the last decade of if you are doing self-storage these days, it needs to meet certain criteria to be relevant. And we'll get into that. But the reality is when you think of self-storage, you think of baby boomers and heirlooms and bulky furniture. The reality is that that's changed. Right now, we have a situation tragically in the country where especially young people are no longer able to buy homes, right? Because of the interest rates and the massive increase in equity from money being poured into the system through COVID and everything else that's happened. What you have is you have a generation of renters, right? And the generation of renters, the millennial population currently is the largest population segment in the country. They're 34% of the population, but they're utilizing 38% of self-storage. And here's why. Those bulky items that you traditionally think about is not the way the consumers are looking at self-storage anymore. Self-storage has become an extension of the closet or extension of the garage. If you own a home, you have an attic, a basement, a garage, depending on where you are in the country. If you are renting, traditionally you are renting based upon the square footage that you get. So what we're seeing in the Southeast is instead of renting a 2-bedroom condo for $1,800 a month, you may rent a 1-bedroom condo for $1,300 a month and then get a $150 a month climate controlled self-storage facility and use that instead of paying for an extra bedroom in your living space, right? So that consumer, previously the average consumer was in a self-storage facility 1 to 2 times a year. The current consumers in that millennial population are in the facility more than 3 times per month. It's like 2.8 to 3.2. It's somewhere right in that range, depending on the region where you are. But what they're doing is they're showing up at 6 a.m. on a Saturday morning. They're grabbing their fishing rod and their waders or their snowboard and their bibs or their mountain bike or their surfboard. that they don't have room to keep in their rented apartment and they're headed to the mountains, to the beach, whatever. These are lifestyle items. They don't have as much stuff as the previous generation did. The things that they do have are important to them, and they're lifestyle items, the mountain bikes, the surfboards, the wakeboards, that kind of stuff. So they need to be able to get in and out of a facility early in the morning or late in the evening on a weekend on their way in and out of town, and they're going by there a lot. So what really matters, if you, the listener, are thinking about investing into self-storage these days, it needs to be several things. It needs to be safe, secure, well-lit, easy access, centrally located, and it has to be climate controlled, right? So that's the product. And now you talk about the cycle, and people talk about oversaturation. Yes, across the board, there are a lot of pockets where self-storage can be oversaturated. You know what really matters with a self-storage facility? It's about 7 miles. 7 miles is about as far as people want to drive to get to a self-storage facility. You're not driving 15 miles across town to get a unit that's $20 cheaper per month. It's about proximity, especially if you're the consumer that's using it more and often than anyone previously did. And we still haven't even talked about businesses that closed down during COVID, an office space that got moved out of, and people are now doing drop shipping and working remotely and operating their companies or their cleaning companies or their asphalt paving company out of self-storage facilities. Businesses are making up a very large population segment there as well. So that's where things are moving. From a residential density standpoint, what we care about is about the 7-mile radius. We'd like to have 10,000 people in a 1-mile radius, about 25,000 in a 3-mile, great visibility, great traffic count. But the reality is, like, if I go find a piece of land, 5 to 7 acres, and we're going to build a facility from the ground up, the cost of capital right now is prohibitive because of the interest rates.
Right.
The construction, permitting, and engineering is going to take 2 to 3 years by the time you do the entitlements and everything else and get that built. After 2 to 3 years, and you have interest reserves that are getting eaten up by the interest rates of the current debt, that you are still making those payments while you're building it, while you're developing it. And when you finish that, it's empty. You still have no cash flow. Now you got to fill it up. That's a problem. This past year, new self-storage hitting the market, new development was only 2.9% of all self-storage on the market. Huge reduction. And we've seen a screeching halt. Development of new self-storage is down 15%. 2025 is what it looks like from the permits filed. It looks like it's going to be down 18% next year. And it's going to take at least through 2027 before it comes back to baseline, because the cost of capital is too high and the cost of steel is up 20 to 30% over what it was a year ago. So that's what's happening across the self-storage industry. The margins are getting compressed, and it's not great. If you are paying the going rate per square foot for new development of self-storage, it's going to cost you the cost of the land. Obviously, it's different on the West Coast, but where we are, it's going to be the cost of the land. It's going to cost you $120 a square foot, and it's going to cost you 2 to 3 years to get it done. If we focus on buying old vacant big box retail buildings, we can get them for pennies on the dollar compared to the replacement cost. We can build them out ourselves. And on average, we're at or around $65 a square foot for the building, the land, the construction, everything. So that conversion, and we're seeing people do that with old mills turn into multifamily apartments, and people taking old malls and converting them into manufacturing space. Anytime there's an asset class conversion and you're changing the formula by which the asset is valued, and you're taking an old defunct property and you're giving it new life, there's opportunity there. So it's really, we do have to look at the fundamentals of self-storage, but what we are doing is self-storage for half the cost of new development and in about a third of the time. So I think it gives us insulation. It also gives us insulation on the back end where if we needed to, we could cut our prices to half of the competition and still be fine. We don't play that game, and we haven't had to, but we could. It's the basis, right? You want that ground level bulletproof basis because we're buying a building that's been sitting dark for 12 years.
Yeah.
So that's the idea. There are challenges in the self-storage space. The biggest challenge, the only thing that you really can't control, is how much other storage is in the market. That's why our model is We want to buy the old textile mill in the middle of a secondary or tertiary market across the Southeast. For instance, like you won't find us in Charlotte, North Carolina right now, but you will find us 15 miles away in Gastonia, North Carolina, where we bought the 77,000 square foot old soda bottling facility that used to make Sundrop soda that we've converted to climate controlled storage that's right on the main road. Even if a competitor wanted to come into that market, it's going to be really hard for them to find the space, the 5 to 7 acres it would take to build something new within a few miles of us. So we like snatching up those old vacant big box retail buildings that have really high residential density around there. A lot of younger people getting pushed out of the more expensive urban areas into these smaller secondary, tertiary markets that are having massive growth in terms of multifamily projects coming to market. We want to grab the old building right in the middle with 10,000 people in a 1 mile, 25,000 in a 3 mile. We get the building for pennies on the dollar. We convert it and we're open in 12 months. So that's the model.
That's great. That's wonderful. Then, so the topic of this particular webinar is passive investing. Have you been able to, thinking back on what you do, been able to pivot to that passive investing, or is it still some active? I know you're part of the GP, so it's probably an unfair question.
No, it's a great question. It's a great question, and it's a loaded answer. And I'm because I'm a little bit of a psycho because I love it. I love it. I'm a student of the game. I want to be a lifelong learner, and I love it. I am in the process. I've taken all 3 of my retirement accounts that I used to have for medical sales. I converted all those to self-directed accounts, and I have those invested into other passive opportunities. I am in storage with a different group, and I'm in multifamily and a couple of different opportunities. I'm in a beverage company. The reality is I can't invest that money into Nomad because I'm a general partner, and it's called commingling, and it's illegal. So that is money that I've got invested into other opportunities. I also put cash into all of our deals that we do. And as these deals are paying out, I have money that's going back into Nomad. I'm diversifying into other deals. The reality is I think if I'm still healthy, I'll be doing this when I'm 80 years old because I love it. And I'm crazy like that. And so are my partners.
Yeah.
But the idea is, and I'll go back to something we talked about earlier. You know, I always thought that if you really want to educate yourself on something, you should read books and listen to podcasts. I've changed my opinion on that if you really, really want to learn about something, you should do what you're doing, John. You should start a podcast. I started a podcast with my co-host called Truly Passive Income because I was after the aggressive pursuit of all things truly passive. And here's why. If I find the smartest people I can across any different investment strategies and I invite them to lunch, no chance would they ever go to lunch with me unless I paid them maybe $5,000 or $10,000. But if I invite them onto my podcast and I give them a platform to put the word out about what they're up to, they're more than happy to do that. And so, you know, I believe in the law of 100 hours. You spend 100 hours focusing on something and you give it your full attention, then if you do that for a year, you're going to have greater knowledge about that subject matter than 99% of the population. Well, 100 hours in a year is only 18 minutes a day. That's less than the average car ride. So I used to think, oh, okay, I'll get that by listening to podcasts. The reality is, I think by doing podcasts and recording podcasts and hosting in a situation where I shut up, which obviously is hard for me to do, and I listen more,
Right.
that's a situation where I learn more. And so I am a passive investor, and I'll be a LP investor for life. A lot of the surgeons, cardiologists, pulmonologists, ER doctors, and EPs that I used to work with are now they are active passive investors. What I mean by that, they are LP investors, but they're paying close attention. They're learning, they're listening to the monthly newsletters, the quarterly reports, and they're learning and they want to get better because the reality is we all have to get to the point of breaking the cycle of trading time for money. The way I think about it is when I or anybody else makes a passive investment into an alternative investment strategy, just like you guys focus on, they're buying future days off. When you buy enough of them, you don't have to go back to work. So I am still an active investor. I am in the process of liquidating my 14 Airbnb properties right now. All of those are going to be converted into passive investment strategies. but I'll always continue to be a GP as well with Nomad because I love my team and I love what we're doing and I love value add. That doesn't mean the market's not going to change over the next few years or decades, and we have to adjust our strategy. Our job is to listen to what the market is telling us, but there will always be opportunity for those that know how to look, especially if you know how to network, and especially if you know how to raise capital, and especially if you are a GC and you can control your own fixed overhead cost.
Yeah, those are great insights. Thank you very much for that. I would say for those individuals that have, and I know there's some live listeners now, if you have questions for Clint, by all means, put them into the Q&A chat window. We can ask those questions of Clint. If you aspire to be Clint, as we all do,
Please don't.
then put your questions in the chat window. So one question I did have about storage is, so I have fielded a couple of investments on luxury storage, and not just like the 10 by 15s, but like the very, very large boxes for RVs and the like. Yes. And so like, what is your perspective on those? I mean, it's I've heard mixed opinions on those.
So we've looked at this pretty closely, and there's a group close by that has just completed one. They were fully leased up before they even broke ground, which I was really impressed with. A lot of times the model that I'm seeing is that people are selling half of them and keeping half of them
Right.
to get price. But these are vanilla boxes. A lot of times you can put a loft in them. It can fit an RV inside the vanilla shell, but you can put a loft, you can put a bathroom, that kind of thing. A lot of times they'll have boat wash stations outside, but there's not much going on. Some of these are selling for like 250 grand, and then within a year trading for 350, 400, 450 because the supply is very, very low. And some people are using them to run businesses out of them. A lot of people are just using them as a place to keep classic cars in their toolkit, and it's a man cave, and they put a poker table in there. I think that we're going to see a split there and a little bit of a dichotomy of those are probably going to make sense in most markets, just about all markets, as long as you have the residential density there and you can get the construction cost down low enough. But the ones that are really trading, the class A facilities that are trading higher and higher in value, I really think you have to have a very high residential density of millionaires within probably a 5-mile radius. The people that are putting the high-end RVs, the high-end boats, you're talking about somebody who can buy a $350,000, $400,000 RV that's going to auto races and things like that. I think if you're positioned around like a Lake Norman in the North South Carolina area, or around like one of the larger racetracks and things like that, we're seeing that's where they first started kind of popping up, and now it's made its way to the masses a little bit. So I see value everywhere, but if you're trying to really have that class A facility and really push the boundaries as to what you can get price per square foot, I think it needs to be in a residential density that has a lot of wealth. And if you can build a facility, we priced a facility, I was going to cost $14 million to build it across from an area called St. James, which is in Eastern North Carolina, very wealthy area as well. If you can position right outside of an area like that, it probably has great opportunity. However, it's very early in the life cycle of this asset class. And I would say that the potential pitfall is the same thing it is for storage. The only thing you can't control is how much competition is coming to the market. And if that market comes, if it all comes on market at the same time, there's going to be a race to the bottom. And as there's a race to the bottom, there's only so many things you can do to cut the cost of what you're building. It's concrete, asphalt, metal frame buildings, insulation, and a roof. So I have a feeling that there's this little bit of a spike right now that I'm watching pretty closely. There's going to be some stability. It kind of reminds me of the early days in storage, where the first guy to throw up a metal low slung building for storage, everybody thought he was an idiot until it worked. Right. And it started growing in popularity. There's been a boom. It's still a fairly fragmented market, but now it's consolidating very quickly. And there's institutional players coming in and making, Cube Smart and U-Haul and places like that are making big plays. I wouldn't be surprised if that happens at some point in time, but yeah, I would expect the supply to boom over the next 5 to 7 years before it creates some level of stability. We looked hard at it. We are GCs. We've done ground up construction on the past on self-storage facilities. There's no reason we couldn't do it. It just can't beat the metrics of what we're doing with these conversions because we
Yeah.
still have a very large supply of these giant big box retail buildings that have gone dark. It's really not, deal flow is not the problem for us right now. So I think that we just want to do one thing and do it really well. We feel like we're really good at it. We want to keep doing until we feel like we're great at it.
Got it. Okay. Thank you for that. Putting on your LP hat and like all the investments that you've made so far, how would you go about evaluating new investments now? Do you have a buy box that you're looking at, time horizon, passive income versus capital appreciation?
So I'm going to give you the right answer, and then I'm going to give you my answer. Right? The right answer is over time, we all should be looking to diversify. But I think that diversification definition has likely changed over the last couple of years. And there's a couple components that we should all add, right? Traditionally, everybody wants to diversify with different assets, different geography, and different operator. I think that the biggest thing that we've been missing until the interest rate hike of a couple of years ago is people were not diversified against debt structure, and people were not diversified across time cycle. I spoke with one investor who is in 7 different deals, some multifamily deals, a vineyard, multifamily, a car wash, storage, and something else. He's fairly well diversified. But what he didn't look is the financing for all of those. They all carry variable rate debt or some level of bridge. So when those interest rates shot up higher and faster than they ever have in history, he was in different assets, different geography with different operators, and they all tanked. 4 of them stopped distributions. 2 of them ended up having capital calls. 1 of them had capital call, and it ended up being a total loss, right? And that one total loss can really wipe out the gains that you made from some of your other investments over a couple of years. And it takes you some rebound. So I think that over time, we would like to all be diversified across different assets, geography, operator, debt structure, and time cycle. I tend, because I'm in the space, I tend to gravitate towards the operators that I know, like, and trust, and that I have been close to, and I know their morals and their ethics and their communication. Communication is paramount. It's extremely important. And I've seen 2 different operators go through the same situation, caught with their pants down with bad bridge debt. And I saw one navigate it in a very poor manner with poor communication. I saw somebody else navigate the same situation with great communication and making sure that there was opportunities in their next deals to make those investors whole. And it was astounding to me that they could go through a bad situation and earn loyalty. And I had investors that are invested in our deals and their deals tell me, you know what, the way they handled this, I'll never go look for another multifamily operator. I'm investing with them for the rest of my investing career. I think it comes down to how you handle bad things. Happen to all of us. It comes down to how you handle it and the way that you communicate that. So for me, that tends to be the direction I look at, unless I'm looking for something like I need instant depreciation or something like that. It may be a situation like oil and gas is a better fit for the financial situation that I'm in, or something along that level.
Yeah. How are you rounding out that portfolio? Because a lot of real estate investments, depreciation up front, maybe some passive income, capital appreciation in years, call it 4, 5, 6, 7, right? Oil and gas is a good way to diversify against that. Cash flow up front, tax write-offs immediately, but then the cash flow peters out over time. How else have you sought to diversify kind of your portfolio mix, not necessarily asset class, as much as like timing the cash flows and then tax write-offs?
I think it really comes down to kind of where you are in your life cycle. Like I'm 42, but I've got a 5-year-old and a 2-year-old. Right. So I've been pretty cavalier with my money. I'm extremely conservative with investor money, but when it comes to money, I've been willing to take some shots and try some things that I haven't seen other people doing. And over the long run, that's traditionally really worked out for me. Not always, but it has, but it's not something I would encourage anybody else to do. I'm really big into offshore fishing and spearfishing. And I would go offshore and I'd dive 120 feet deep and I'd shoot some really big fish and catch lobsters and fight sharks off on the way up. And that's just kind of what I did. Well, now I've got a 5-year-old and a 2-year-old. And that changes your thinking. You have 1 or 2 falls, I don't dive that deep anymore. I don't get that aggressive anymore. I'd rather stay on the boat, let my buddies do that. And I think that I'm feeling myself change. And my priority is to set my family up and to make sure that what I'm really focusing on is that independence of purpose, that I have time to focus on what I want to build with my wife and the businesses that we're building, and then focus on meaningful time raising my kids, where I have major concerns about. I live on an island. I grew up as one of six, lower middle class family with, surrounded by very little money. And now we live in a community. It's not the wealthiest beach town around, but there is a lot of money there. And I have concerns about raising, little jerks, right? I want my
Yeah.
sons to
Yeah.
be people that have positive impacts on the people around them in their community. And
That's
so
great.
to me, the most important thing is independence of purpose that allows my wife and I to focus on travel, not to resorts and cruises, but to areas that are less privileged, where we can try to focus on building character that is going to turn them into better people and help them realize that we do live in a bubble. This is not normal. And we need to have gratitude for that. And outside of that, we need to have empathy for everybody else and look for ways to help. So my motivation is completely changed. And I'm not necessarily looking for just focus on depreciation or asset class or anything else. I'm looking for independence of purpose that's going to allow me to frame for my sons what the amount of time that I spend with them looks like, because I think that's going to frame the amount of time that hopefully they spend with their kids and on down the line. I think that's the best way for me to have a meaningful impact on the generations that are here long after I'm gone, versus just focusing on money or something like that. So I think about money a lot and I talk about money a lot, but the reality is I don't believe that it buys or brings happiness, but I think it does create options. Now, what we do with those options is our obligation and responsibility. So for me, I'm feeling this trepidation of risk that I never had before, because I feel like that's the direction I'm being pulled in for my family. And so I still do things with my money and the investments that I make that I wouldn't advise other people to do. But the biggest thing for me is probably right now a heavier emphasis on cash flow. As a younger man, I was always willing to take the bigger returns if they were farther down the road. That's fine. Now, a moderate level of cash flow is fine, because what I do as a GP is building. It gives me a lot of depreciation and building a lot of value very long down the road, because we get paid after all the investors do. So that's
Right.
kind of the balance for me. And it's more focused on independence of purpose than anything else.
Got it. That's great. And thank you for sharing that. One question that we do ask everyone is, and you've kind of alluded to it, how do you give back to your community?
Well, I have a 2-year-old. So
Yeah.
right now it's tough, right?
Right, right.
It's hard. The best way for us to do it right now is in our local community. We live on a small island community, and trying to be part of that and be involved with our church and giving back in a meaningful way, and trying to set the example of who we want our kids to grow up into. Over time, I have visions of, we want to set up a family foundation, and create a purpose behind that with a family constitution that gives us a purpose greater than ourselves, that we as a family can lean into. That's a reason for us to get together monthly for dinners and quarterly for business meetings, that it keeps us together with an outlook on how we can affect the world around us.
Mm.
So right now we're hindered is the best way to put it. I wouldn't do anything for the world, but with a 5-year-old and a 2-year-old, some of the ways I'm giving back right now is through church and coaching T-ball. But I have visions that's changing over the next few years as we get a little bit more autonomy and travel becomes easier.
Okay. That's great. The other question we always ask is, think about, I know you're in your 40s, but think about maybe 20 years ago, a younger version of yourself. What advice would you give to a young Clint?
Great question. I think that it would be one of the lessons I picked up from my partners is that risk is a muscle, and in order, no muscle is going to build without resistance, and focusing on increasing my own knowledge, being a lifelong learner, educating constantly, surrounding yourself with people smarter than you are. Understand that you are who you are right now is who you're going to be when you're 42 instead of 22, with the exception of the places you go, the people you meet, the content that you consume in terms of books, podcasts, or anything else. So I would say educate constantly. Don't waste the windshield time. I used to have to rent real estate books on CD at the library, and now we have access to that indefinitely, right? So I would say don't waste that time. Be a sponge, be a lifelong student, and always be up for a new challenge, because the reality is that risk is a muscle. And the more that you work that muscle, the stronger it gets. And the next time you see opportunity, even if it has a few more zeros than you're used to, you understand the fundamentals and you can be willing to go after it because you've worked those muscles.
That's great. Thanks for that comment. That great answer. And that's why we have great guests like yourself, Clint. How do investors find out more information about you and Nomad Capital?
The easiest way is through our website, nomadcapital.us. We call it Nomad Capital because a nomad goes where they want, when they want, and does what they want. And that's the life that we're looking to build. My partners are a father and son team of Eric and Levi Hemingway. They founded Nomad Capital. Eric built his first self-storage in 2006 when the market crashed in 2008.
Right.
Wife and 5 kids got on a 36-foot catamaran sailboat in Greece, bought it sight unseen. They sailed the Mediterranean for 3.5 years, stopped and had a 6th kid in Jerusalem along the way, and eventually sailed all the way back across the Atlantic Ocean, landed in Wilmington where we are, and started building again. The idea of that self-storage facility allowing Eric and his wife and 6 kids to live on a sailboat for 3.5 years sparked the idea that eventually turned into Nomad. And I think that's what we really all want. What everybody's nomad experience is going to look different, but what you want is the ability to go where you want, when you want, do what you want, and live like a nomad if that's what you choose, because you have commercial assets that are paying for that for you. So that's the reason behind the name. It's something that I'm really proud of, that story and what they did as a family, and they mean a lot to me. And the best way to connect with us is nomadcapital.us.
Great. We'll include that contact information in the description of this podcast episode as well. Again, thank you very much for the time, Clint. Amazing stories, amazing company. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you great content like today's content. Thanks, everyone. Until next time, keep learning to invest for generational wealth. And thanks, Clint.
Thanks, John. Appreciate your time.
Thanks, everyone. Have a good day.